Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah.
And I'm Mike. This week we're covering the period from February 15th through February 22nd, 2026, and we saw some interesting divergence across the aviation sector.
We really did, Mike. Let me set the stage here. We had JetBlue Airways leading the pack with a 3.68% gain, while Alaska Airlines took a significant hit, dropping 7.49%. What's your initial take on this week's trading action?
Sarah, what strikes me immediately is the dispersion we're seeing. This wasn't a week where the entire sector moved in lockstep. We had clear winners and losers, which tells me investors are making very specific bets on individual carriers rather than broad sector plays.
That's a great point. Let's dive into the overall market performance first. We tracked 11 major aviation stocks this week, and the results were quite mixed. Alaska Airlines, as I mentioned, was our biggest loser at negative 7.49%, closing at $52.13. American Airlines also struggled, down 5.25% to $13.35. Allegiant Air fell 4.86% to $104.18. Delta dropped 3.37% to $67.44, and Boeing declined 3.12% to $233.71.
What matters is that we're seeing a clear bifurcation in the market. On the positive side, JetBlue led with that 3.68% gain to $5.91. AerCap Holdings gained 2.65% to $151.32. And Southwest managed a respectable 1.96% increase to $52.08. United held relatively steady, down just 0.23% at $110.05.
The more important signal is what this dispersion tells us about investor sentiment. We're not seeing broad sector rotation here. This looks much more like stock-specific stories driving individual performance. Mike, when you see this kind of mixed performance, what does that typically indicate about where we are in the cycle?
It suggests we're in a mature phase where fundamentals really matter. When you have a sector-wide theme driving everything, you get more correlated moves. But when investors are picking and choosing based on individual company metrics, balance sheet strength, route networks, and operational efficiency, that's when you see this kind of dispersion. It's actually a healthy sign for price discovery in the market.
That makes a lot of sense. Now let's talk about our narrative of the week, because I think there's a clear theme emerging from the data.
Absolutely. This week's narrative was carrier-specific, operational and financial differentiation, driving stock selection over broad sector momentum. Operationally, this suggests investors are focusing on individual airlines' capacity management, route profitability, and cost structure advantages rather than making macro aviation plays. For investors, this means stock picking based on fundamental analysis is likely to outperform sector-wide strategies in the current environment.
Perfect. Now let's turn to our top gainer spotlight, and that's JetBlue Airways. Mike, JetBlue closed at $5.91, up 3.68% for the week. What's driving this outperformance?
JetBlue's move is particularly interesting when you consider the broader context. While many of the legacy carriers were under pressure, JetBlue managed to buck that trend. At $5.91, the stock is still trading at relatively modest levels, which suggests there might be some value recognition happening here.
When I look at JetBlue's positioning, they've been working through some significant operational challenges over the past couple of years. Are we potentially seeing the market starting to recognize some improvement in their operational metrics?
That's exactly what I'm thinking, Sarah. JetBlue has been focused heavily on improving their operational reliability, and they've been making some tough decisions about route optimization. Sometimes the market takes a while to recognize when these operational improvements start to translate into financial performance.
What about their competitive positioning? JetBlue operates in some pretty challenging markets, particularly in the Northeast, where you have a lot of slot constraints and operational complexity.
True, but that's also where their brand differentiation really matters. JetBlue has maintained a premium service offering compared to the ultra low cost carriers, while still being more affordable than the legacy carriers on many routes. When operational performance improves, that value proposition becomes much more compelling to both consumers and investors.
And from a balance sheet perspective, how does JetBlue stack up against some of the other carriers we track?
JetBlue has generally maintained a more conservative approach to leverage compared to some of their peers. They went through the pandemic with less aggressive debt accumulation than some others, which gives them more flexibility now as the industry continues to recover and adapt to changing demand patterns.
That's a crucial point. So when we think about JetBlue's 3.68% gain this week, in the context of their overall strategy and positioning, what's your assessment of whether this move is sustainable?
I think it depends on execution. The market appears to be giving JetBlue credit for potential operational improvements and their strategic positioning. But to sustain this momentum, they'll need to demonstrate consistent operational performance and show that their route network optimization efforts are actually flowing through to the bottom line. The fundamentals need to follow the stock price.
Excellent analysis. Now let's shift gears and talk about SEC filings, because we had some significant activity this week. We saw 4 total filings across our coverage universe, with 10K annual reports from both Frontier Airlines and American Airlines.
Right, we had American Airlines file their 10K on February 18th, and Frontier also filed their 10K the same day. Additionally, Alaska Airlines and Allegiant both filed Form 4s on February 20th, which are typically insider trading reports.
The timing of these 10K filings is interesting because we're now getting the full year 2025 picture from both a legacy carrier in American and an ultra low-cost carrier in Frontier. What does that comparison typically tell us about the different business models?
The 10K filings are crucial because they give us the complete annual financial picture along with management's detailed commentary on operational performance, strategic initiatives, and forward-looking guidance. When you have both American and Frontier filing in the same week, it provides a great opportunity to compare how different business models perform through the same operating environment.
Unfortunately, we don't have the parsed content from these filings yet, but historically, what are the key metrics you focus on when comparing a legacy carrier like American versus an ULCC like Frontier?
Great question. For American, I'm always looking at their unit revenue trends, particularly in their premium segments, their operational metrics like on-time performance and completion rates, and how they're managing their cost structure, especially labor costs. For Frontier, it's all about load factors, ancillary revenue generation, and their ability to maintain that ultra-low cost structure while still achieving acceptable operational reliability.
The Form 4 filings from Alaska and Allegiant on February 20th are also worth noting. These insider trading reports often provide insights into management confidence levels.
Exactly. While we need to look at the specific details of those filings to understand whether we're seeing buying or selling activity, the timing is interesting given Alaska's significant stock decline this week. Sometimes you'll see insider buying during temporary sell-offs if management believes the market is overreacting to near-term challenges.
This week's filings reinforced prior themes rather than introducing new structural shifts, but they're still important for establishing the baseline financial health as we move through 2026.
Absolutely. And investors should expect more 10K filings over the next few weeks as we work through the annual reporting cycle. These documents will be crucial for understanding how each carrier is positioned for the year ahead.
Now, let's move to our news roundup. We had one interesting story this week that caught our attention. Xert AI wants to save human experts time, not replace them. Mike, this touches on a theme that's becoming increasingly important across aviation, the integration of artificial intelligence and technology solutions.
This is a fascinating development, Sarah. The aviation industry has always been data intensive, but the application of AI technologies is really accelerating. When I see a story like this about AI augmenting human expertise rather than replacing it, that's exactly the kind of approach that makes sense for aviation.
Why is that augmentation approach particularly important in aviation compared to other industries?
Aviation is an industry where safety and reliability are absolutely paramount. You can't just automate everything and hope for the best, but there are tremendous opportunities to use AI to help human experts process data more efficiently, identify patterns they might miss, and make better informed decisions faster. Whether that's in maintenance scheduling, route optimization, pricing strategies, or operational planning.
From an investor perspective, how should we think about airlines and aviation companies that are successfully integrating these AI technologies?
It's going to be a significant competitive advantage over time. Airlines that can use AI to optimize their operations, improve their maintenance efficiency, better predict demand patterns, and enhance their customer experience are going to have meaningful cost advantages and potentially higher revenue generation capabilities.
Are there specific areas within airline operations where you think AI implementation is likely to have the biggest impact?
Revenue management is probably the most obvious one. Airlines have been using sophisticated algorithms for pricing and inventory management for decades, but AI is taking that to new levels. Predictive maintenance is another huge opportunity, where AI can analyze engine data, component wear patterns, and operational stresses to predict when maintenance will be needed before something actually fails.
That predictive maintenance piece is particularly interesting because unscheduled maintenance is one of the biggest operational disruptors for airlines.
Exactly. And operational disruption is incredibly expensive. When you have to cancel flights or delay passengers, the costs cascade through the entire system. AI that can help prevent those disruptions by predicting and preventing equipment failures before they happen could have enormous value.
Looking at our coverage universe, are there particular carriers that seem to be ahead of the curve on AI and technology integration?
The larger carriers generally have more resources to invest in these technologies. United, Delta, and American have all been talking about various AI initiatives. But sometimes the smaller carriers can be more agile in implementing new technologies because they have less legacy infrastructure to work around.
That's a great point about agility versus resources. Now let's turn to our top loser analysis, and unfortunately that's Alaska Airlines, which dropped 7.49% this week to close at $52.13.
Alaska's decline is particularly notable because it was significantly worse than most of the sector. When you see a nearly 7.5% drop in a single week for an established carrier like Alaska, that usually indicates either company-specific news or some kind of operational issue that's concerning investors.
Alaska has generally been viewed as one of the more efficiently operated carriers, particularly on the West Coast. What kinds of factors typically drive this magnitude of sell-off for a carrier with Alaska's operational reputation?
There are several possibilities. It could be related to competitive pressures in their key markets, particularly if there's increased capacity from other carriers on Alaska's core routes. It could be operational challenges, maybe some weather-related disruptions that impacted their performance metrics. Or it could be related to cost pressures, whether that's fuel, labor, or other operational costs.
Alaska also has some unique exposure compared to other carriers. Their route network is heavily concentrated in specific geographic markets, which can be both an advantage and a vulnerability.
That's exactly right, Sarah. Alaska's strength in the Pacific Northwest and their Alaska routes gives them some nice competitive moats, but it also means they're more exposed to regional economic conditions and seasonal demand variations. If there are concerns about economic conditions in those key markets, that could disproportionately impact Alaska compared to carriers with more geographically diversified route networks.
We also noted that Alaska filed a Form 4 on February 20th. Without seeing the details, that insider trading report might provide some clues about whether management views this sell-off as an overreaction or if there are legitimate concerns about the business.
That's a great point. If we see insider buying activity shortly after a significant stock decline, that's often a positive signal that management believes the market has overreacted. Conversely, if there's selling activity, that might suggest the challenges are more fundamental.
From a technical perspective, where does Alaska's stock stand after this decline?
At $52.13, Alaska is still trading at levels that aren't dramatically different from where they've been over the past year. But the sharp decline does suggest investors are reevaluating something about the investment thesis. The question is whether this is a temporary setback or the beginning of a more significant reassessment of Alaska's prospects.
Looking ahead, what would you be watching for from Alaska to determine if this sell-off represents a buying opportunity or a legitimate concern?
I'd be looking for their next operational performance report, any commentary from management about demand trends in their key markets, and their ability to maintain pricing power on their core routes. Alaska has generally been good at managing through challenges, but they'll need to demonstrate that their competitive position remains strong.
Now let's look ahead to the week ahead. What should investors be watching for as we move into the next reporting period?
First, I'll be watching for any additional 10K filings as companies continue working through their annual reporting requirements. We should get more color on how the various carriers finished 2025 and what their expectations are for 2026.
Any particular carriers or metrics you'll be focusing on?
I'm particularly interested in seeing more detail from United, Delta, and Southwest when they report, since they didn't have major filings this week. Their commentary on demand trends, pricing environment, and operational performance will be crucial for understanding the sector's trajectory.
What about operational metrics? Are there specific performance indicators that might give us early signals about how the quarter is shaping up?
On-time performance and completion rates are always good leading indicators. If we start seeing deterioration in operational metrics, that often shows up in financial performance a few weeks later. Conversely, operational improvements often precede financial outperformance.
And from a broader market perspective, any macro factors that could impact aviation stocks in the coming week?
Energy prices remain important for airline cost structures, so any significant moves in oil prices could impact the sector. Economic data that gives us insights into consumer spending and business travel demand is also always relevant. And of course, any weather events that could disrupt operations are worth monitoring.
Looking at the technical setup after this week's mixed performance, how would you characterize the sector's positioning heading into the next week?
The dispersion we saw this week suggests the market is being selective rather than making broad sector bets. That environment tends to reward companies that can demonstrate operational excellence and financial discipline. I think we're in a phase where individual company fundamentals matter more than sector-wide themes.
Before we wrap up, let's synthesize what this week tells us about the current state of aviation investing.
This week suggests investors are prioritizing operational differentiation and balance sheet quality over broad sector momentum, signaling that the aviation industry has moved beyond recovery mode into a more mature phase where individual competitive advantages drive stock performance.
That's a perfect summary, Mike. As always, listeners should remember that this podcast is for informational purposes only and should not be considered investment advice. Please consult with your financial advisor before making any investment decisions.
Thanks for joining us for another episode of Aviation Intelligence Weekly. I'm Mike.
And I'm Sarah. We'll be back next week with more analysis of the aviation markets. Until then, safe travels.